In this episode, we talk about what to do when you've planned the best you can financially and you're still running out of money. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to this week's episode. I feel like I have been all over the place the last couple of months. I just got back from what I hope is my last work trip for the year. I served on a panel at the CFP Connections conference about the future of financial advice. It was a great time. And while I was there meeting and talking with other financial advisors, you talk with your peers about things that you're going through or your clients are going through. And many of us have people, as I've discussed on the podcast, who are going through what I call the white collar recession. And now, as a result of the recent government shutdown, several of us had clients who are either in government or connected to government in their roles, who are either furloughed or are essential and are being asked to work for free, even though they will get that money back eventually. If you're somebody who's been a part of these big layoffs, you're not getting your money back. And what the common theme was, we have people that we feel we've counseled well and who have saved well. They've done all they can do. They've done the 6 months expenses. They've done the year's expenses, but they have been without a job for 6 months. They've been without a job for a year. And no matter how good their planning has gone, they've reached the point where they are at the end of their emergency reserves. And to me, this is where I think there's a big shortfall in financial advice. If you look online, you see a lot of here's what you should do to prepare for an emergency, or here's the rule of thumb. Here's how much you should budget. Here's how much you should put aside. But there's not a lot of advice of like break glass in case of emergency level when it comes to what you should do with your money. So in this episode, I wanted to give some information, give some advice, give some options for what you can do when, in spite of your best efforts, you've reached a point where you're just at the end of your available resources and you're wondering what else can be cut. This episode is for you. Now, before I get into some of these tips, I want to give a number of caveats. The first is these are not recommendations. These are simply options that you can consider, and you want to make sure that in your particular situation, you evaluate whether or not it's a fit for you. The second is there are varying levels of extremity, right? These are not just all on a level 1 or a level 5. Some of these are on a level 10. Some of them are on a level 2. So again, you want to make sure that you evaluate how relevant it is to your particular circumstance. The next caveat is these are not in order. This is not like step 1, do this, step 2, do that. It is truly just kind of a listing of some things that I have counseled people on who find themselves in a similar situation. And if it is of any relief, this is a wide range of people who I've seen in this circumstance. This doesn't just happen to people who are low income earners who didn't put money aside. We're having these conversations with people who are in the multi six figures, who have just been in a tough situation for a very long period of time, who saved well. But even in those situations, you're not always up. And sometimes the emergency part of the emergency reserves can be stretched to its limit. If that is of any help in your current situation, I hope that you can lean on that for comfort. So let's get into some of the things that I have seen be helpful, even as a pause or a delay until your circumstances improve. The first is a tip that we've covered on the podcast before, and that is to discuss your available options for debt payments with your lenders. This is a tip that I share over and over again when people are worried about their options, when finances are in a rough shape and they owe money for certain debts. I tell them, do not take this opportunity to run away from your lenders. The more communicative you are with them about your current situation, the more options you'll discover that you can to delay, pause, or put yourself in a better situation with those debts. And options are going to vary based on the debt that you're negotiating, but I want to make you aware of some things that we see in given situations. We're going to start with a mortgage. If you're looking on screen, you're looking at an article from Consumer Financial Protection Bureau talking about mortgage forbearance, and it shares some of the options. The first of them being a formal forbearance period, and I've seen that stretch anywhere from 3 months to a year. And depending on the lender, the options that they give you on the end of that forbearance will vary. I've seen options where you may be able to avoid payments for 3 months, but at the end of the 3 months, you have to make a lump sum payment of those missed payments, which really doesn't make sense. If you could have made a lump sum payment, you would have just paid them during that period. However, I've also seen forbearance where they'll say, hey, we're going to give you 3 months of forbearance or 6 months of forbearance, and we're going to take those 6 months or 3 months that you missed, and we're going to add those to your mortgage payment until it's repaid. So, for example, they would say if you missed $20,000 worth of payments over a certain period of time, we're going to take that $20,000 and break it up over this period and over the course of the next year or 18 months, add what's needed to your original mortgage payment so that at the end of the term, what you missed during forbearance is repaid. Another option that I saw frequently during the pandemic was an option where they will simply take the amount that you missed during forbearance and tack it on to the end of the loan. So at the end of the 30-year mortgage payment, they're just putting at the end of the amortization period, which in my experience has had the lowest impact on what your mortgage payment ends up being when you come out of forbearance. But these are some of the ways that mortgage forbearance can typically work. You'll also find that with credit card companies, they will often have a hardship program or offer their own form of forbearance, but it's not something that they're going to publicly put on their website or offer an application for. In most cases, you actually have to call them and ask to be put in touch with someone who can help you when you're unable to make a payment. As a matter of fact, staying on screen, you can see on chase.com what happens if you can't pay your credit card, and they give you all types of options for what to do if you can't pay. But one of those options is to call the number on the back of your credit card. And it says, and I quote, be prepared to explain that you missed a credit card payment and maybe some additional context. You may be transferred to a representative who specializes in helping card members based on their specific situations. Again, it's not going to be publicly stated because the offer that they give you can vary from person to person, but we've seen people with credit card debts that they can't pay be offered a period where they make no payments at all. We've seen people have their interest rate lowered on their current debt so that that balance doesn't continue to explode. But this is another example where communicating with your lender gives you access to a program that they have behind the scenes that is not publicly marketed, and all comes as a result of you being proactive and letting them know the situation in which you find yourself. This is also true with federal and private student loans. If you are someone who listens to our separate Escape Student Loan Debt podcast, you know that with federal student loans, you can ask for forbearance for economic reasons for up to a year consecutively or 3 years over the course of your loan repayment. But I would also encourage you, if you're someone who pays your loans using an income-driven repayment plan, to instead of putting your student loans on forbearance, consider contacting your loan servicer and asking them to recalculate your payment. If you're in a single income household and you have no income, you can stay on an income-driven repayment plan for a federal student loan, have your payment recalculated to $0, but still receive credit towards forgiveness programs like those offered under income-driven repayment. But even if you have reduced income and you're part of a two-income household, you can still ask for them to recalculate your payment based on your reduced income and at least lower the amount while still receiving credit for that federal student loan. With private student loans, you'll also find, unlike how it worked when I first got into this industry, when they used to publicly state the rules of economic hardship forbearance, that many private student loan lenders offer these programs, they just don't publicize them. They offer in-school deferment, and typically these hardship forbearances are for a period of 3 months, and it may not exceed 12 or 18 months over the course of the loan. If you're looking on screen now, we're pulling up SoFi.com, and you'll see that that information has been hidden, but it's not gone away completely. Looking at the screen, it says, does SoFi have any deferment or forbearance options? It says, and I quote, SoFi offers our borrowers a variety of deferment and forbearance options. For a hardship forbearance due to involuntary employment, you may apply through SoFi.com. They're not going to give you the details of the program. They're not going to promise you certain information, but they are saying if you're proactive about reaching out to us, we can see if there's a program available to you, but you have to reach out to us first to let us know the situation. Now, the word of warning that I would give you for all of these circumstances is if you can avoid it, you don't want to pursue any of these programs in a way that negatively impacts your credit if you have other options available. So while you do need to be proactive in letting your lender know and asking what's available, you also want to make sure that you get details from them in writing about the impact of whatever program you might accept on your credit. You want to make sure that you have an understanding of how that information is being reported. Now, obviously, depending on the severity of your financial circumstance, it may be something where you say, hey, I need the no payment more than I need a better credit score right now. But I just want to make sure that you don't completely neglect the fact that certain lenders report these types of programs to credit bureaus differently than others. Since we just talked about credit cards, the next thing we'll talk about are balance transfer cards. Balance transfer cards, as a recap, are cards that offer you an introductory period when you open them where you can take debts that you owe on other credit cards and transfer onto the new card at a period where there's a 0% interest rate. So they'll charge you a transfer fee of say 3 or 4% to bring the funds over. And then as a part of that introductory offer, they may say for the next 12 to 18 months, you can leave it here without any interest accruing on your debt. All of these cards are giving you the opportunity when you need to have flexibility in your cash flow the most to look at a credit card debt and say, it's not that I don't want to pay this down, but I can't pay it down right now. The minimum payment is killing me, and I don't want to watch my credit card balance increase. It may be an opportunity after evaluating the pros and cons of opening another card to take that balance, move it over so that it's not growing at interest, and also reduce your minimum payment in a way that increases the flexibility of your cash flow. Next up, pausing your automatic contributions. We have seen people who, well-meaning, like I said, a lot of people in this circumstance are people who were saving and they continue at a rapid clip even when cash flow is being crunched, contributing to things like an investment fund, like a non-qualified brokerage account or a 401k. And remember, this is all based on levels of severity. So the lengths to which you take this can vary from person to person. But I can tell you, if you're truly in a cash crunch, it may be a time where you can take a pause on those contributions to a non-qualified investment account where there's not some type of match where you're like leaving free money on the table by stopping that contribution. With retirement contributions, it's a little more dependent on how severe your situation is. For example, if you're just dealing with reduced income, but you still have decent cash flow, it may be too severe for you to stop your retirement contributions, especially if you're in a situation where you're receiving a decent match from your employer, because stopping that retirement contribution could mean leaving free money on the table. But there's a difference between like the best financial decision in the long run and the best financial decision you can make now. So let's say that cash flow is really struggling. I would argue that if there's someone in your household still earning an income and there's money that you can put back into your now pockets by reducing, if not stopping, those retirement contribution, the now dollars may be more valuable than the later dollars in this circumstance. So if you are really in that crunch, the level of severity you might take is, I do need to put a pause on these retirement contributions as well until we're in a better situation in terms of how much money is coming in the door. Next up, a couple cash flow items. The first of them being evaluating your subscription. This is an easy one. If you have done our 30 Money Moves challenge, the link to which I'll put in the show notes, you know that one of the first things that we recommend you doing is just getting an idea of the things that you're paying for automatically. When you have 7 or 8 or 9 subscriptions, it's not that big of a deal when cash flow is strong, but you would be surprised how much of a relief even being able to say that you reduced your expenses by $100 a month can be during times of financial hardship. So it may not be $100 a month. It may be $8 here, $9 there. But if you can do away with things that you're not actually using at a high clip, it prevents you from having to cut down to the level where you're having to make substantive changes to your budget, which is the next thing where if you reach that level, you do have to start to evaluate the to and fro of your daily life. And I can tell you that that's a miserable place to be. So my preference is to comb through your budget to find the things that you're not using first. And then as things get more dire, start to actually evaluate the things that require more effort and sacrifice on your end. But if you can identify some of those low-hanging fruit, then hopefully you don't have to get to the point where you're starting to think about, do you have to live on a beans and rice budget? And one thing that I would talk about before we go to break that has more to do with keeping your resume sharp and even putting money in your pocket while you're waiting for a full-time gig is over the course of the creation of this firm to now, we've used services like Fiverr and Upwork consistently, whether it be marketing help, design, graphics, even coding for certain projects. And if you have not been on those platforms before to hire, you may have never looked on the back end of the roles that are available for hire on those sites. But it's the perfect, in my opinion, opportunity to keep your resume sharp through project-based work that in some instances can not only pay very well, but could be exactly what you're looking for, where you need something to keep money in your pocket, but you're not looking for a permanent role. And I think there's a radical underestimation of the types of roles that are on these sites. A lot of times when I talk to people, they think that it's just creative work. If you're looking on screen, you can type in pretty much everything you can think of when it comes to work experience. If you're looking on screen right now on Upwork, and you can find similar sites, we have searched for human resources roles. And you're seeing things on here that pay anywhere from $40 to $100 an hour. In some cases, the roles are looking for people for as short as a month, and some they're looking for people for 3 to 6 months, 6 months or longer. On this next page, we're on the same site looking for product marketing roles, and we're seeing pay as low as $15 an hour up to $200 an hour for roles that, again, may be less than 30 hours a week. It may be longer than 6 months, 1 to 3 months. The next page, we're looking for healthcare consultants, and you can see the same thing. The first job that you see available is healthcare integration consultant for a US-based role for more than 6 months, paying anywhere from $70 to $120 an hour, and they're asking for less than 30 hours a week. There are many roles on here depending on your specialty, where if you are trying to make sure that if you have lost your job and you're trying to find something that can give you an opportunity to keep developing a resume and get paid, you would also consider these types of sites as well.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
Before the break, we talked about pausing retirement contributions. But if you're the type of person who in the past has contributed to things like a Roth IRA, you may not be aware of the fact that with the Roth IRA, in certain circumstances, you can access your contributions or your basis to the account even before age 59 and a half. So for example, if over the years you've put $10,000 into a Roth IRA that's grown to $20,000, you may be able to access that $10,000 at any age without penalty or taxes because the funds that went into the Roth IRA had already been taxed. Again, a pretty severe circumstance to dip into your retirement dollars, but it's that weighing out of the future money versus the now money and trying to find resources that will allow you to access them without penalty can put you in a situation where the basis of your Roth IRA is up for grabs, and you need to know that it's up for grabs as a potential option. If you or your spouse or partner are still employed and you have a 401k or 403b available to you at your job, you may also be able to do a 401k or 403b loan. Now, with these types of loans, you're going to be limited to how much you can borrow. They're going to say that you can borrow the lesser of 50% of your account or $50,000. So if you have a $30,000 401k, you're going to be able to borrow 50% of that, being $15,000. But if you have a $200,000 401k, you can't borrow 50% of that. You would be limited to the $50,000 to a 401k loan. Now, again, if you look online, everything that you read online is going to tell you that this is one of the worst things that you can do. But again, we're here to talk about what you can do when you don't have many options left. And one of the upsides, if there are any, to taking the 401k or 403b loan is that it's repaid through payroll. You don't have to worry about coming up with extra money outside your budget and having the discipline to put it aside. It's also something where, depending on the loan terms, it may be repaid over 3 to 5 years. And when you get your paycheck every 2 weeks or once a month, the funds to repay that loan have already been deducted from your check, and you're essentially paying yourself back. I don't want to state this as if it's just a great thing to do. In almost all cases, I would discourage someone from having a 401k loan. But if you compare a 401k loan to something that impacts your credit by going to apply with a lender and may have a higher interest rate and more aggressive repayment terms, a 401k might look more attractive than the available alternatives. And lastly, if you have non-qualified investments like a non-qualified brokerage account, there is a lot of flexibility, as we've discussed in the past, about these accounts. And most of the flexibility we're talking about in times of flourishing, right? Like our coffers are full and we have this money that we're putting aside in these non-qualified brokerage accounts, and we can access it at any age. There's no limit to how much we can contribute. There's all these types of benefits. Well, in times of hardship, there's some flexibility to these accounts as well that you don't find with your qualified retirement accounts. One of those measures of flexibility is the fact that you can access that money without penalty, but it could be accessed in a way that causes taxation. We've covered long-term and short-term capital gains on this podcast. Short-term capital gains are when you sell an investment for a gain that you've held for less than a year. A long-term capital gain occurs when you sell an investment for a gain that you've held for less than a year and a day. Short-term capital gains are taxed at your ordinary income rate. So if the highest portion of your regular income is taxed at 24%, you're going to pay 24% on a short-term capital gain. A long-term capital gain, in most cases, unless you are just earning a very small amount of money or a very, very large amount of money, most people in the middle are going to pay 15% in capital gains tax. But if you do have some built-in losses into your account, then you can be strategic in raising cash from your portfolio that not only doesn't lead to more taxation, it can actually reduce your taxes. This is one example of the flexibility of a non-qualified investment account. The other has to do with how that account can be collateralized or leveraged through something called a securities-backed line of credit. A securities-backed line of credit is very similar to a home equity line of credit, where just like with your home, they look at how much equity you have and they give you a line of credit where you can tap into some of that equity. The same is true with a securities-backed line of credit. If you have $100,000 in a non-qualified brokerage account, they might give you a securities-backed line of credit for $50,000. Now, if I have $100,000 in my account and a $50,000 line of credit against that money, let's say that I borrow $10,000 from that line of credit. I still have $100,000. They're not reducing it from my investment. They're using that investment as collateral. And when I take that $10,000, I'm taking $10,000 of my available $50,000 line of credit. I'm not taking $10,000 from my $100,000 in investments. There's all types of flexibility to the repayment of these securities-backed lines of credit. It's interest only in terms of the required payment, which means in this time of financial hardship, you don't have to owe an arm and a leg. You're only required to pay the interest. If you keep the money in that account and you have enough collateral, there is in most cases no end date as to when you have to repay the money that you borrowed. This would be an extreme scenario because it's going to cost you more over the long run to not pay it back. But conceptually, if you borrowed that $10,000 and kept enough money in your investment account, you could pay interest only on those funds forever. There's not going to be an end date where they require those funds to be repaid. So when you're trying to balance accessing the capital with how much it's going to add to your budget trying to repay what you borrowed, a securities-backed line of credit can in some cases be even more attractive than a home equity line of credit, which in most cases is going to need to be repaid within somewhere between 10 to 20 years. But either one of these options in extreme scenarios need to be evaluated. And even if you choose not to take advantage of it, all we're talking about in this podcast is about learning and understanding your burn rate. And if you're an entrepreneur, you're very familiar with the term burn rate. It essentially means you're looking at your available assets and your available income, and you're trying to determine just how long you can burn through that cash before you literally have to close up shop. And all I'm trying to do in this episode is to extend your burn rate as long as possible so that when you're in these hopefully temporary situations, you give yourself enough room to pivot, to get through it with as little burns on your body as possible. And when you get on the other side of it, being able to put the pieces back together because you did the best job in the moment of limiting the damage to your financial portfolio. Again, I hope that you take all of these with a grain of salt. I hope you compare them to your financial circumstance and figure out which option may or may not work for you. It is definitely not a blanket recommendation for you to do all of them or any of them without going through that process. But I hope that if you do find yourself in dire straits, that I said something today that is at least somewhat helpful. We'll be back next week with a more conventional episode where we're talking about growing wealth and positive things to put some good juju in the air. And I hope to see you there.